In this era where AI is fundamentally reshaping online search and content, the big question for investors is, can a company like Semrush not only maintain its lead, but actually translate digital visibility into tangible long-term value for you? Welcome to the Deep Dive. Today we're taking a close look into Semrush Holdings, Inc., traded on the NYSE as SEMR. Our analysis is anchored to July 23, 2025, and a share price of $10. Our mission really is to distill the most important insights from a comprehensive research report, helping you understand what truly makes Semrush tick, its biggest opportunities, and its most significant challenges. We've structured this deep dive into two parts. First, we'll tackle the business itself, its management, and the financials. Then we'll move into market sentiment, ownership, and key risks before bringing it all together in our conclusion. So let's unpack this business. To start, what exactly does Semrush do, and how does it generate revenue?
Right. So Semrush operates on a subscription-based software as a service, or SaaS, model. This means highly predictable and scalable recurring revenue. They offer multi-price point tiers, serving everyone from individual marketers and small businesses, right up to large enterprises.
And their freemium approach is a real standout, isn't it?
Absolutely, it's key. They attract over 1 million registered free active users. As of Q1 2025, they've converted around 118,000 of those into paying subscribers.
Wow, okay.
Yeah, and this massive free user base isn't just a lead list. It's a testament to their product's stickiness. The real insight here is probably their conversion efficiency. It gives them a concrete, low-cost lever for future growth compared to, acquiring completely new customers from scratch.
Makes sense. What are the core tools, then, that make up this platform?
It's a pretty comprehensive, all-in-one marketing suite. We're talking more than 55 distinct tools. These are organized around AI-powered hubs for things like search engine optimization, paid advertising, often called PPC, social media management, content marketing, brand marketing, and of course, competitive research.
And have they been an early adopter of AI? That seems critical now.
Yes, quite early, actually. They've been experimenting with generative AI since way back in 2019. This has led to some high-value products like their AI toolkit and sophisticated enterprise SEO solutions. That AI integration is really key for their strategic pivot upmarket.
Okay, so how does Semrush really stack up against the competition?
Well, they're widely recognized as a leading online visibility management SaaS platform. They were even named a leader in Forrester Research's Q3 2025 report on SEO solutions.
That's strong validation.
It is. Their profound competitive advantage really comes from their deep proprietary data set. They're analyzing over 200 million domains and 26 billion keywords globally. That's just a massive scale, very tough to replicate. And they serve about 40% of Fortune 500 companies now, alongside their historical SMB base.
So what does this all mean for you as a business customer using their platform? What's the value proposition?
Basically, Semrush helps companies enhance their online visibility. They take what management calls messy, fragmented marketing signals and distill them into clear, real-time insights that drive action. The overarching goal is to simplify the complexities of modern marketing and ultimately deliver measurable results.
Stepping back a bit, how big is the overall market Semrush operates in?
Oh, it's large, dynamic, and rapidly expanding. The global SEO software market was $74.6 billion in 2024. It's projected to more than double to $154.6 billion by 2030. That's a 13.5% compound annual growth rate. Yeah, and digital marketing analytics is growing even faster, over 20% NTAGR. This robust growth is mainly driven by the expansion of e-commerce, content marketing, and mobile usage worldwide.
A booming market like that often means fierce competition, though. What does that landscape look like?
You're right. It's intensely competitive and highly fragmented. Direct competitors include names like Ahrefs, Moz, SimilarWeb, SE Ranking. While Semrush boasts that all-in-one platform, some rivals, like Ahrefs, for example, are known for superior niche capabilities, particularly in things like backlink analysis.
How does regulation play a role in this global software business? GDPR, CCPA.
Right. As a global SaaS company handling vast amounts of data, they face complex and frankly evolving regulations like GDPR in the EU and CCPA here in the US. And the emergence of AI brings new regulatory uncertainty too, like the EU AI Act. That could impose significant new compliance costs and, engineering resources just to ensure data privacy across dozens of jurisdictions.
What actually protects established players like Semrush from new companies trying to enter the market? What are the barriers to entry?
The most formidable barrier is definitely their proprietary data and technology. Building a comparable data infrastructure, tracking billions of keywords, millions of domains would require immense capital and a lot of time.
Right.
Beyond that, you've got entrenched competition, their 15-plus years of brand recognition, and the significant switching costs for teams and enterprises once Semrush is integrated into their workflows. It becomes sticky.
So their competitive advantage, their economic moat,
Hmm.
it's built on those intangible assets.
Exactly. Primarily intangible assets.
Tell us more about those.
Okay, so first, brand strength and recognition. They're cited by major media, used by over 10 million marketers. That counts for a lot. Second, their collaborative features create network effects and, as we said, significant switching costs. Makes teams stickier.
Okay.
But most significant is their massive proprietary data set. This is what Forrester says truly sets it apart. It creates this powerful, self-reinforcing flywheel. The data powers better tools, which attract more customers who then generate even more data, which leads to even better tools.
That makes sense.
Now, a crucial point here, AI. It's both their biggest growth opportunity and potentially a profound technological risk. You see, traditional SEO value is in ranking those blue links on Google.
Right.
But if AI-powered search, like Google's AI overviews, increasingly provides direct conversational answers, the value of getting that #1 organic result could, well, diminish dramatically. Semrush is in a high-stakes race to redefine its value proposition from just ranking higher to being visible within those AI-generated results.
So they're effectively having to adapt their core offering for this new AI future.
Precisely. And there's another nuance. They're all-in-one platform with over 55 tools. It drives customer stickiness and upsells, sure, but it might actually cap their share of wallet in the most lucrative segments. Highly sophisticated users or large enterprises might still opt for specialized best-of-breed tools over Semrush's integrated approach for specific niche capabilities.
Interesting point. Okay, let's shift our focus to the people at the helm. Who's leading Semrush now and what's their background? Give us the rundown.
No. Okay. Semrush has undergone a pretty strategic evolution in leadership recently. In March 2025, William Bill R. Wagner became CEO. He's a known SaaS veteran, maybe most notably scaling Logman from about $140 million to over $1 billion in revenue.
Wow, okay.
So his appointment signals a clear focus on disciplined scaling, especially cracking that enterprise market.
And co-founder Oleg Shigalev moved into a new role.
Yes, he transitioned to Chief Technology Officer. This allows him to focus exclusively on product innovation, particularly critical work in AI. And Brian Mulroy, the CFO since 2023, brings over 2 decades of high-level finance experience from places like Microsoft and Nuance. That's highly relevant given Semrush's active acquisition strategy.
Now, the company has a formal code of business conduct and ethics, and they provide detailed financial reports, which sounds good for transparency.
They do publicly commit to high ethical standards and transparency. However, their practical application has been questioned, particularly concerning that Backlinko blog controversy we touched on earlier.
Right, the article editing.
Exactly. After acquiring Backlinko, Semrush allegedly edited an Ahrefs versus Semrush comparison article on the site to favor its own product without clear disclosure. The industry perceived their defense of that as dismissive, frankly. It created a disconnect between their stated code and their public actions, and that did impact their brand reputation and objectivity among some marketers.
Okay. How does Semrush typically deploy its capital then? Where does the money go?
Their strategy is squarely focused on reinvestment for long-term growth. Primarily, that means research and development, R&D, and a very active mergers and acquisitions program. M&A is big for them.
They've been quite acquisitive, haven't they? Buying up companies.
Indeed. Since early 2022, they've made some notable acquisitions. Backlinko for SEO training, Compite for competitive intelligence, Datos for clickstream data, which is vital for AI, Third Door Media for industry publications, Brand24 for brand monitoring, Right for technical SEO.
Okay, quite a list.
Yeah. This buy and build strategy is really designed for rapid capability expansion and, crucially, cross-selling opportunities within their existing customer base.
Do they return capital to shareholders? Dividends or share buybacks?
No, not currently. Consistent with being a high-growth tech company, they retain all earnings for reinvestment back into the business. There are no dividends or share buyback programs in place. So as an investor, you should really expect returns to come purely from stock appreciation if they materialize. And this brings up a critical point about capital efficiency. For much of its history, Semrush's return on invested capital, or ROIC, was actually negative. Yeah, it's positive now, which is good, but it's still in the low single digits. We're talking 1.68% to 2.51%.
So what's the investment implication of that low ROIC? What does that mean for us?
Well, conceptually, ROIC shows how much profit is generated for every dollar invested back into the company. Now, for a company to actually create economic value, its ROIC needs to exceed its weighted average cost of capital, the WACC.
Yeah.
For a high-growth tech company like Semrush, the WACC might be, say, 8–12%, reflecting the market's high return expectations and the inherent risk. A low ROIC like Semrush's indicates that, historically at least, their growth investments haven't been generating enough return to cover that cost of capital. Basically, they've been destroying economic value on those investments. It absolutely must show a clear upward trajectory to be a compelling long-term investment story. So, the key takeaway on management. While the hiring of Bill Wagner is definitely a bullish indicator, it signals a shift from that growth at all costs mentality towards more disciplined, profitable scaling, particularly in the enterprise segment. However, that aggressive M&A strategy introduces significant integration risk. If they fail to seamlessly weave these acquisitions into a cohesive, all-in-one platform, it could lead to a bloated user experience or, just reveal they overpaid for assets.
That low ROIC is definitely a metric to watch for improvement going forward.
Absolutely. It's a clear sign their past investments haven't been super efficient in generating returns, and that's a metric you as an investor should watch very closely.
Okay, now for the numbers. Let's dive into the financial analysis.
Yeah.
What do the core financials tell us about Semrush? Let's start with market cap.
Right. As of July 23, 2025, Semrush has a market capitalization of approximately $1.48 billion. That places it firmly in the small cap to mid cap segment of the market.
They've shown impressive revenue growth over the years, haven't they?
Yes, they have a strong track record of rapid and pretty consistent revenue growth. It went from $92.11 million back in 2019 to $376.82 million in 2024. That's a compound annual growth rate, or CAGR, of over 32%.
Pretty strong.
Very strong. For the trailing 12 months, or TTM, ending March 31st, 2025, revenue was $396.02 million, and their 2025 guidance projects about 20% growth. So still strong growth, but decelerating from those earlier highs.
Okay. And how about profitability? That's often the question with growth companies.
Yeah, and this is where we see a really significant positive transformation. They have exceptionally high and stable gross margins, which is characteristic of good SaaS businesses, an impressive 82.15% TTM.
82%.
Yeah, very high. Historically, they operated at a loss as they focused on growth, but they reached GAAP profitability in 2023 and then again in 2024. For the TTM, operating margin was 1.82% and net profit margin was 1.75%. Still thin margins, yes, but this inflection to profitability is a crucial milestone in their financial maturation. And free cash flow, or FCF, this is vital for value investors. It's the actual cash a company generates after paying for all its operations and investments, basically, the real money they have left over. After a period of cash burn back in 2022, they've shown strong FCF generation recently. For the TTM ending Q1 2025, Semrush generated $50.55 million in FCF. That gives them a healthy 12.76% FCF margin. This robust cash generation, even with only modest net income so far, really shows the favorable cash dynamics of their SaaS model.
How financially stable is the company overall? Thinking about earnings consistency, debt levels.
Okay, so they don't have a long track record of consistent earnings because, as we said, they were growth-focused and incurred losses for years. But they first reported positive net income in fiscal year 2023 and then saw a substantial increase in fiscal year 2024 to $8.24 million. That powerful upward trend is very positive.
And their debt.
Their balance sheet is exceptionally strong. They are virtually debt-free. Debt-to-equity ratio is either 0% or a negligible 0.05%, depending on how you calculate minor leases. This conservative capital structure provides a substantial margin of safety. Their short-term liquidity is also excellent with a current ratio of 2.35. That means current assets are more than double current liabilities. Very healthy.
So a financially healthy company focused on growth, not returning cash via dividends, right?
Exactly. You should view this as a financially sound company prioritizing future expansion.
Let's talk valuation then. The trailing price to earnings, or PE ratio, looks extremely high at first glance.
It does. On a trailing basis, Semrush appears expensive. The PE has ranged from 107 up to over 210 recently. That's significantly higher than the software industry median, which is around 29.4.
So why the big difference?
Well, it's a bit misleading because that high trailing PE is based on very small nascent earnings as they've only just become profitable on a GAAP basis. A more useful, forward-looking perspective shows a forward PE estimate of somewhere between 22 and 37, and the price-to-free cash flow ratio is around 25 to 29. Now, these multiples still indicate the market expects solid growth, but they're far more reasonable for a growing SaaS company compared to that trailing PE.
How do we think about intrinsic value for a company like Semrush? Is DCF useful here?
Yeah, intrinsic value is essentially the discounted value of all the cash a company's expected to generate over its lifetime. A discounted cash flow, or DCF analysis, attempts to forecast those future cash flows and discount them back to their present value. While building a full model is complex, Morningstar, using their DCF methodology, assesses Semrush as fairly valued right around this $10 share price. Their valuation range is $7.11 on the low end, which would be significantly undervalued up to $13.48, which they'd consider overvalued. So $10 sits right in the middle, suggesting the market is pricing it quite rationally, according to their model.
What are the crucial assumptions that go into a DCF model like that for Semrush?
Key inputs would definitely include a high, but importantly, decelerating revenue growth rate, maybe something like 18.5% for the next 5 years, then tapering off. Also, expanding free cash flow margins, moving from the current roughly 13% towards maybe 20-25%, which is more typical for mature SaaS companies. And then, crucially, a discount rate, or WACC, likely in the 10-12% range, reflecting its risk profile and high stock volatility. Its beta is quite high at 1.66. So, the most significant financial development, the real cornerstone of the bull case here, is that recent inflection to both GAAP profitability and substantial free cash flow generation. It shows the business is finally reaching a scale where those high gross margins are enough to cover the operating investments.
And that pristine balance sheet really stands out as well. You don't see that often with growth tech.
Absolutely. That debt-free balance sheet with over $260 million in cash is huge. It provides a crucial margin of safety, immense operational flexibility to fund M&A, weather potential downturns, and frankly, outinvest competitors if needed.
Okay, that covers the financials. Now, let's look at what the broader market is saying about Semrush. What are Wall Street analysts saying? Are they bullish, bearish?
Sentiment among the Wall Street analysts who cover Semrush is overwhelmingly positive. There's a strong buy consensus rating across the board from the 6 to 8 brokerage firms actively following the company.
And what are their price targets looking like for the next 12 months?
The average 12-month price target is consistently sitting between $15.17 and $17. Now, compared to the current $10 share price, that implies a significant potential upside somewhere in the range of 50% to 70%.
Wow.
Yeah, and even the lowest forecast out there is $12. So literally every single analyst covering the stock sees upside from the current price.
What's the general media buzz? Any recent news impacting perception?
The general media tone is also pretty positive. The focus tends to be on their consistent revenue growth, that successful pivot towards enterprise clients, the Forrester leader recognition we mentioned, and their ongoing AI innovation. Their Q1 2025 earnings release, even though it had a minor earnings per share miss, still showed strong underlying fundamentals. It only caused a brief dip in the stock price.
But there's often a flip side, isn't there? What about short interest? Are people betting against the stock?
Yes, and this is where it gets interesting. While the analysts are clearly bullish, there's a notable bearish contingent in the market, which we can see from the short interest data. It's quite substantial, running between 8.28% and 11.32% of the publicly available float. The short ratio, or days to cover, is about 3.8 to 4.8 days.
What does that level of short interest tell you as an investor? What's the likely reason?
Well, given their strong balance sheet and positive cash flow, this almost certainly isn't about fears of financial distress or bankruptcy. It's far more likely a valuation protest.
Oh.
Yeah, these are investors betting the stock is simply overvalued at its current levels. They're likely looking at that high trailing PE we discussed, perhaps questioning the sustainability of growth given the deceleration from 50% down to the low 20s, and maybe factoring in those significant technological threats from AI. They essentially believe the market will eventually re-rate the stock lower.
What does the technical chart say about the stock's trend? Looking at moving averages, for instance.
Okay, technically, the stock is trading slightly above its 50-day moving average, which sits around $9.58, $10.69. That indicates some recent positive momentum. However, it's still trading below its 200-day moving average, which is higher up, around $11.46 to $11.99. That signifies a broader, longer-term downtrend is still technically in place. So the key takeaway on sentiment is this significant disconnect. You've got highly bullish professional analysts on one side, and then more cautious market performance and significant short interest on the other. Analysts seem focused on the long-term value potential, driven by profitability and growth opportunities. But the market appears to be weighing those near-term risks more heavily: the high valuation, intense competition, the AI disruption potential, and maybe broader macroeconomic concerns.
So for you, the listener, it's really about understanding that gap. Are the analysts seeing a hidden opportunity the market is missing, or is the market correctly pricing in risks that the analysts might be underestimating? Interesting dichotomy. Now let's explore who actually owns Semrush. What does the share registry tell us? Who are the main owners of Semrush? Institutions, insiders.
Okay, so institutional investors hold a majority, about 57% of the outstanding shares. This includes some early-stage venture capital firms like Greycroft, but also large established asset managers like Vanguard and BlackRock. Looking at recent activity, it's a bit mixed. Some institutions, like Wellington and Goldman Sachs, have been increasing their stakes, while others, like Catrock Capital, have been reducing or selling out completely.
What about the founders and executives? How much skin do they have in the game, and what do their transactions look like?
Insider ownership is highly concentrated. The co-founders, Oleg Shegelev holds about 35.0%, and Dmitry Melnikov holds around 17.8%. They are by far the largest individual shareholders. Generally, this high ownership aligns their interests pretty well with long-term company performance.
That sounds good, that alignment. But what about recent insider sales? Has there been much selling?
Yes, and this presents a potentially cautionary data point. Over the last 12 months, insiders have consistently sold shares. There's been a net disposition of over 400,000 shares, and crucially, a near-total absence of any open market purchases by insiders. Now, some sales are often automatic. For tax withholding related to stock awards vesting, that's normal. But the complete lack of any discretionary open market buys from key insiders.
Well,
It suggests they don't view the stock as compellingly cheap at its current price. That's definitely a noteworthy signal for you to consider.
and there's a dual-class share structure here as well, right? How does that work?
Yes, that's a critical feature of their governance. Class A shares, the ones traded on the NYSE, get 1 vote per share. But Class B shares, which are held mainly by the founders and early investors, get 10 votes per share.
10 votes.
10 votes. This structure concentrates voting control firmly with the founding team. Co-founders Shigalev and Melnikov collectively control a majority of the total voting power. This gives them effective control over major corporate decisions, like electing directors or approving mergers. So, the key takeaway on ownership: that dual-class share structure is a significant corporate governance risk for public shareholders, plain and simple, because it effectively disenfranchises them. While founder control can sometimes be beneficial, especially early on, it removes important checks and balances that typically protect minority shareholders.
And that insider selling pattern, without any corresponding buying, that sends a powerful signal, doesn't it? Even if subtle.
It really does. It provides a subtle yet potentially powerful signal about management's own perception of the stock's current valuation. It doesn't necessarily mean they think the company is failing, not at all, but it does suggest they don't see it as significantly undervalued at this particular price point.
Okay, understood. Let's turn now to the overall risk picture for Semrush. Let's frame this with a SWOT analysis: strengths, weaknesses, opportunities, threats. What are the most critical factors that jump out?
Okay, starting with strengths. The most critical, I'd say, is their leading market position, which is really anchored by that vast proprietary data set and their comprehensive all-in-one platform. Combine that with their excellent financial health, being debt-free, strong cash position, recent profitability, and you have a strong foundation. And of course, the experienced new CEO and CFO are key strengths now too. On the weakness side, 2 really stand out. First, the high valuation multiples we discussed. They price in significant future growth, leaving less room for error. Second, their historically low return on invested capital, the ROIC, which absolutely needs to show clear improvement to justify long-term investment.
Okay, opportunities.
For opportunities, the most compelling are probably the significant growth potential remaining in the enterprise market, especially with the new leadership focus. Also, capitalizing on new AI-powered products and continuing their strategic M&A to bolt on new capabilities. International expansion is likely still an opportunity too. And finally, threats. You've got the intense competition, naturally. There are also macroeconomic headwinds potentially affecting their large SMB customer base. Think inflation, interest rates, squeezing budgets. But by far the most significant threat, the existential one really, is technological disruption from AI fundamentally reshaping search itself.
You mentioned tariffs earlier. That seems like an odd risk for a pure software company. How exactly does that factor in?
Yeah, it's indirect, but potentially still impactful. The 2025 U.S. tariffs on technology hardware wouldn't hit Semrush directly, but they could increase their operating costs. SaaS platforms like Semrush run on massive physical server infrastructure, often rented from cloud providers like AWS or Google Cloud. If those cloud providers face higher hardware costs due to tariffs, they will likely pass those costs down to customers like Semrush in the form of increased cloud hosting and data service fees. That would put downward pressure on Semrush's margins. But let's be clear. The single most significant external threat facing Semrush is not a specific competitor like RF's. It's the potential for technological obsolescence driven by artificial intelligence. Semrush's core business depends deeply on the mechanics of Google search as we know it today.
The blue links.
Exactly, ranking those blue links. If AI-powered search engines like Google's AI Overviews or similar technologies increasingly provide direct conversational answers right on the results page, the fundamental value of achieving a #1 organic ranking could dramatically diminish. Why click a link if the answer is right there?
That really does sound like an existential threat to their core business model.
It absolutely is. It represents a potential existential threat, not just to Semrush, but arguably to the entire traditional SEO market they serve. Their future viability, looking out several years, is probably less about outmaneuvering RFs or MAs and much more about successfully navigating this profound technological shift, the adoption rate, and, critically, the monetization success of their new AI-focused products. Those are the single most critical factors for you as an investor to monitor going forward.
A very stark warning there. Okay, let's try to put all these pieces together now in our conclusion. So let's synthesize everything we've discussed. What's the strong argument for Semrush as an investment right now, the bull case?
Okay, the bull case rests on Semrush being a clear market leader in a large and growing industry digital visibility. They have a defensible competitive advantage, primarily stemming from that vast proprietary data set and their integrated all-in-one SaaS platform, which boasts those very high gross margins. Financially, the most compelling development is that recent inflection to both GAAP profitability and strong free cash flow generation. That shows the business model is scaling effectively.
And the balance sheet helps.
Hugely.
Right.
It's backed by a fortress-like, debt-free balance sheet providing safety and flexibility. Add in the new CEO signaling a shift towards disciplined, profitable growth and significant future opportunities in the enterprise market and leveraging AI. That's the core bull argument.
Okay, now what are the key arguments against it, the bear case?
The bear case highlights several points. First, the stock still carries a demanding valuation based on its relatively nascent earnings, leaving little room for execution stumbles. Second, revenue growth has decelerated significantly from its peak. Third, the competitive landscape is intense, and arguably their brand reputation took a hit from that backlinko controversy.
And the big one, AI.
And the biggest one, yes. AI presents a potential existential threat that could fundamentally devalue their core SEO toolkit over time. Lastly, from a governance perspective, that dual-class share structure disenfranchises public shareholders, and the pattern of consistent insider selling without any corresponding buys raises valid questions about management's own conviction in the current valuation. So putting valuation context, our analysis, which seems consistent with third-party DCF models like the one from Morningstar, suggests Semrush is currently trading in a fairly valued range around its current $10 share price. Remember, Morningstar's range was roughly $7.11, which they see as undervalued, up to $13.48 considered overvalued. $10 is right in that ballpark.
Okay, fairly valued. So what's the final word for our listener on Semrush at $10 a share?
Look, Semrush presents a really complex investment profile right now. The market appears to be pricing it quite rationally, actually. It's acknowledging the company's strengths and its growth potential, definitely. But it's also clearly discounting for the risks, the still high valuation multiples relative to current earnings, the intense competition, and crucially, the profound uncertainty introduced by AI's transformation of the entire search industry.
So it's clearly not an investment for every type of portfolio.
No, I don't think so. For a conservative, deep value investor who demands a substantial margin of safety before buying, Semrush at this price might not look like a compelling opportunity. However, for you, if you happen to have a higher tolerance for risk, maybe a longer time horizon, and a strong conviction in the future of the digital marketing industry. And specifically, if you believe in this management team's ability to successfully navigate the major AI shift and scale the enterprise business profitably, then Semrush could represent an attractive, growth at a reasonable price, or JERGARP type proposition.
This deep dive into Semrush really highlights a fascinating tension, doesn't it? How much value do you place on a company's proven past leadership and its current financial strength when its entire future could potentially be reshaped by a technology as disruptive as artificial intelligence? It's really not just about what they have built, but much more about what they can build next. Something to think about. We certainly hope this deep dive helped you become better informed on Semrush.
Yes, and if you enjoyed this in-depth analysis, please remember to like this video and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
And don't forget, Stock Analytics AI members get priority deep dives on tickers they request for just $4.99 a month. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those analyses. If you just want a one-off deep dive on a specific stock that interests you, just drop us a super thanks on the video.
And finally, please remember, this analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.